Well, it's easy to get caught up in the excitement of new highs, but what if I told you that we are heading into one of the worst months of the year for the stock market? Tonight, we are going to be digging into some of the seasonality charts. We'll talk about Bank of America's risk sentiment indicator, rotations I'm watching under the surface, market conditions and why they matter so much, as well as expected moves and some year to date statistics that matter more than ever right now. Plus, we're going to hop into Bitcoin as a potential leading indicator for what can come next. You're watching the Stock Market Brief Show. If you are new here, make sure to subscribe if you like this type of content. Hit that thumbs up to support the channel. Let's get into today's show. Welcome back to the show, everybody. I want to start off here with a tweet, and the tweet was from Steve Depp. He's a charter market technician. It says, when the S&P 500 closes August at an all-time high, which we did, the index has closed red for the month of September 14 out of 18 times with an average loss about 1.6%. September is notoriously known as the worst trading month, which we'll get into some seasonality charts, but it is interesting to compare it also with some of these statistics showing us that, hey, when August does reach these new high ground, typically we have some sort of a consolidation or pullback. This is also happening with the Bank of America's Global Risk Sentiment Indicator. It says that here that it has risen to the 93rd percentile of history since 1987, serving as a sign to be vigilant, but it doesn't call for a change in constructive stance as earnings policy and market breadth remains squarely in favor. So we will look at this as an indicator saying, hey, things are euphoric, things are getting out of hand, but we need to pay more attention to what's happening in the market conditions to be more prepared for when that trigger or when that change can take effect. If you take a look at a SPY, with the last video, we talked about the potential for a bull trap. We came in a little bit and, I would just say this is pretty constructive. Overall, we've just been going sideways in this bull channel with a negative divergence that has been forming. Now, we've also talked about ES and how it's been in this very tight trading range. And you can see we're still holding this 6450. And when we broke from this level, multiple times, we've seen some pretty extravagant moves to the downside. So I'd still be paying very close attention that if we start getting under 6450, we can see the market move rather quickly. Once again, I'm going to be talking more about that in the market conditions section. I want to hop right into rotations now, because I do find some interesting stuff taking place. Now, if I'm looking from a year-to-date perspective on the 11 sectors that make up the S&P 500, up towards the top, we have industrials sector, the XLI, and communication services. And I like to look at sector rotations and the cycle of these and what, when we potentially might be moving into a new era. And one of the charts that I like to look at is this, which is pointing out the kind of market bottom, bull market, market top, and the bear market. And you can kind of see how it moves like such. And the 11 sectors up here are showing you, hey, what performs best at a market top, what performs best going up, leading into a market top. And if you actually look from a year-to-date basis, we have industrials and communication services. So we're really kind of just within this bull market phase. But the reason why I'm pointing this out now is because energy all of a sudden is starting to see some relative strength. So just this last week, and it's only been 1 week, so I just want to call it out and just point it out, but we're talking a pretty significant outperformance, 2.25%. The next competitor was only 0.42. You do have the materials down there and communication services, right? If we pull this chart back up, what's next there? Boom, communication services and materials. So to see this on a week-to-date basis and seeing these names start to catch up, that could be something to just be aware of, that in a shorter term, because this is all fractal, right? Even within these larger cycles, there's smaller cycles where we typically see this as well. Now, if I look at this from just a 5-day trading perspective and we look at the relative rotation graph, you have a leading quadrant, a weakening quadrant, lagging and improving quadrant. What do you notice here is XLE shot up like massively into the leading quadrant. And that's the one that I want to call it the most. It's the longest tail, meaning it's seen the most outperformance, and it's moving into that leading quadrant. And why I find this to be so important is because of this chart here. This chart up here is the relative strength line between energy, right? XLE I'm using as a proxy to SPX. So basically when this line goes up, it tells us that energy is outperforming the overall market, the S&P 500. And when you pair this and you look down here and you just pull up a chart of the SPX or the S&P 500, you notice that when this line goes up, you see the market struggle. When you see this line go up, right, the market struggles. When you see this line goes up, the market pulls back. When you see this line go up, the market pulls back. And what we're seeing here is the line starting to break to the upside, meaning that energy is starting to outperform the S&P 500. And if this continues for the weeks to come, month to come, who knows, that could be a more of a sign that the S&P 500 needs to take a little bit more of a digestion. But as it stands right now, we're still, I mean, overall, we're stone's throw away from a new all-time high. So I just wanted to call that out. Another interesting chart is looking at the relative strength line of consumer staples to the SPY. And I just find it interesting. I shared this chart a few videos ago, but we're at a depressed level here, and there's a lot of consumer staples that have gotten absolutely just destroyed. Now, the consumer staples that are going on here bringing it down are probably, they were different over here, but just in terms of just a technical, testing point, pulling this chart up, dating all the way back to 2000, we're reaching, and we actually undercut those levels, and we haven't seen these levels reached since the S&P 500 was in the peak of its actually .com bubble, which you can see we came up a little bit higher. We kind of had matching highs and then the bursting of that bubble. So are we going to see consumer staples start to outperform? And if so, I want to bring you back over to this chart that we're starting to see energy, right, outperform. And what comes next after energy? Consumer staples, a more safe asset. So as this is, reaching down to these levels, as energy on the shorter time frame is starting to outperform, from a very smaller cycle standpoint, or potentially early signs, are we starting to kind of near the period where we could try to find some sort of a market top and maybe get a 5% correction, 10% correction, maybe bigger? I don't really know. Typically what happens, right, September is pretty weak, and then we get a rally into year's end. Then maybe in 2026, we see something shake up. I'm just putting this now, the data, what we have kind of in front of you. Now, if you look at energy or XLE as of just a relative chart, overall, absolute chart, it's just going nowhere, right, from a year-to-date basis. We're slightly up, right, from here to here. However, we start creeping up here and consolidate and break out, that could be a sign as well. But right now, we saw a pretty strong move, and it has yet to be consolidated. So just, pull up a little bit more, consolidate. Maybe it sets up to go test these levels again as well. Maybe we get a pullback to the 200-day. It takes time to start to curl back around, maybe the 20-day, and it starts to curl back. But we are seeing a series of higher lows being formed right there. And our main pivot for the year is at about 94 to 95 taking place. That was twice actually tested this year. And if you go back further on a weekly time frame, you actually see it go way back. Now, oil also has not really been moving. And the thing with oil is it has a pretty strong correlation to energy stocks. So to see this kind of flatten out, if this starts to break out, that could be a very bullish sign for energy stocks. However, right, if this starts to crack down lower, perhaps maybe we're just getting a fake out in some of these energy names, and this bull market wants to continue to thrust itself in the upwards direction. Maybe not September, but maybe the next month. So continue to monitor that. From an intermarket standpoint, the dollar has been kind of flattening to dropping from this, where I'm marking on this blue line. The 10-year yield also has been falling. And what does that do for the S&P 500? That has been a good negative correlation, right? The correlations broke down a little bit, but overall, that has been a more positive sign for the S&P 500. So if the dollar wants to flatten out to start to turn up in the near term, or even the 10-year yield, right, which would probably mean that oil would go higher too, that could also be a contributing factor for the consolidation, or more of a consolidation in the S&P 500, or pull back. However, if these start to continue to drop, the dollar continues to move lower, that could add more fuel to this overall fire. Now, from a seasonality standpoint, if you take a look at the S&P 500 for the last 5-year average, you can see that we're kind of reaching into the area where you typically see some weakness up until we get a rally into year's end. Now, if I look out deeper and we look at the last 30 years of the SPY, you can see here, based on the last 30 years, 50% of the time we have a green month, 50% of the time, right, it's a red month. So it's basically a coin flip. But if you look, right? That's the worst performing historic month of the year based off of the data that we have. Now that's for the SPY. For the Qs, it's almost one of the worst, right? So this one's actually worse than the SPY, but it's not the worst trading month for the last 27 years for the Qs. Typically February is, but it's not too far off. So 46% of the time, based on the last 27-year history, the Qs finishes green, right? So larger percentage to it being red. Now, IWM for the last 25 years, standout, right? Only 44% of the time it ends up being green. So you can see the performance here from a seasonality standpoint. And you don't need to get too involved into seasonality, but it is worth noting, I guess, that especially when it's like one of the strongest months or when it's the weakest months of the year. So that's what that looks like. Now, let's go back to the last 5 years of history for all the S&P 500 sectors. There's 11 of them. And I want to go by, kind of faster this. It's not too, too crazy, but the main call out here, I'm doing it basically from strongest to least, is energy, XLE, about a 50% probability of it closing higher. And that's based off of the last 5 years. So 50% of the time there, it's green. So that's important to know because that is actually the strongest sector in September based off of the last 5 years of data. So consumer staples, 25, XLU, 25, XLK, 25, XLY, 25. Then we got XLRE, which is 25, and then XLI, which is also 25. And then you can see XLC, we got a 25, and then XLB, 25, and then XLV, which is healthcare. This is actually one of the worst, right? So we actually, I guess apparently here, every month of September for the last 5 years, it's finished down. And then financials too, kind of interestingly here for me is financials the last 5 years in September are down. And if you've really been paying attention, the sector that's been holding up the S&P 500 the last couple of weeks, I mean, the big names, if we're looking at just big names, because the tech has kind of come off a little bit or went sideways, it's been financials, right? Financials have been holding it up. So now we're walking into the worst month of the year, at least for the last 5 years for the financials trade. Now, to dig in a little bit deeper, you can look at the volatility index seasonality chart for the S&P 500, or sorry, for the VIX, and you can see that we get a pop at the beginning, but then towards the back end of the month is when we get the seasonal kind of spike in VIX. And you can see September for the last 5 years, that's a high seasonality, so typically closes higher, right, 100% of the time for the last 5 years. If we look at the dollar, 75% of the time it closes higher, which is one of its strongest months of the year for the last 5. And if you just remember, right, what we just talked about here, how a dollar moving higher, that could put some potential, pause to the S&P 500. Okay, and if you look at the chart from September, when's this kick off? It's actually typically towards the end of the month. So perhaps maybe towards the beginning, nothing really happens too much. It potentially, if the month is going to close red, maybe most of that happens towards the end, right? That's just based off of the seasonality. Now let's take a look at market conditions. If you take a look here, the line slipped just under that 1.20. This is back month versus front month volatility. What we've been talking about, when we reach into this is where markets tend to consolidate and or pull back, and you could see volatility rise there shortly after. And if you just look back through history, right, what do you notice, right? Consolidations, drops, right? Consolidations, pullbacks, right? Consolidations, pullbacks over here. And what have we been doing now? We've been kind of just going sideways here as the market has been pressing higher, and we're still at an elevated level. So if in September we get some sort of volatility scare or the market sinks off, you want to see if this line can reach down under 1.0, because that's typically the time when you want to start to look for consolidation and or a bounce in the markets. And this is also the time when people start fear-mongering absolutely like crazy. So it's very important to look at the dispersion or the difference between this back month and front month volatility, because it could be a very helpful tool to getting you on the right side of trade when there's a lot of fear or euphoria in the markets. If we take a look at the net gamma exposure, 6,500 remains our call wall. However, 6,600 has been growing in size. So traders are reaching out further, which is bullish. So anything under 6,500 and 450, it's a little bit of a danger zone, about 50 points lower to and around 6,400. You can see that here We have our new upper monthly implied moves because we are moving into the month of September. That's at 6692 for the SPX, 622820 our lower implied move. And for the weekly implied move, they're right here. You can mark them on your charts. I'll talk about the statistics around this shortly, but I want to call out here, since we're talking about market conditions, we do remain above the gamma flip line, but we're very close, right, of that 6450, that if we start slipping under this, that's where volatility can really pick up, because that's where dealers look to sell into that selling. They buy into the buying, and volatility typically rises. So we're really in this precarious area, and we've been in it where the gamma flip line is rising and price isn't really going anywhere. And this is becoming more of a neutral environment for delta hedging. And in short, what that means is the price action is kind of comfortable where it's at. However, if it starts breaking from either direction, the dealers are going to have to really kind of uptick and increase that, and start to either one, we start to see a move higher and we start to see volatility suppress further, and or if we break lower, volatility will typically rise, and we'll see some significant moves at a faster rate below that gamma flip line. And if we start crossing under that, there are some firepower behind us, and that would be looking at the CTAs. I brought this chart up by Tier 1 Alpha. I usually share it from my Gamma Lab, but this one had more history on it, which I kind of liked. So if you take a look, this is where CTA position are now. And, these are, at the higher percentile. And when we get to these higher percentiles, the S&P 500 can go through pullbacks and consolidations. It's not, an incredibly fast method of watching, but what you want to pay attention to is these can turn into sellers quickly, but most likely that happens under the gamma flip line. And also, if you look at vol control funds, it's the same thing, right? We're reaching into these kind of historically higher levels, higher percentiles, and they could become sellers. I think that this is up a little bit higher than this now, at least based off of my Gamma Lab one, but nonetheless, the models are probably a little bit different. When they become sellers, they'll probably become more significant sellers, right? And that's what kind of increases volatility and helps kind of move the equity market lower and contributes to the sell side activity in equities if we end up getting underneath that gamma flip line, which roughly is at about 6,400 right now. Okay, so as far as market conditions go, we're still seeing higher highs, higher lows. We're above the gamma flip line, so everything is good. It just, we're kind of walking that fine line, and you got to be very, very, very prepared for if it breaks lower, and then start mapping out these levels, what the market's pricing in for risk, both on a weekly basis and a monthly basis coming into September, because you never know, the month might start out weak, and what happens if we just open the door and we just fly right down to this lower end of 6228? A lot of people would probably freak out, call it the bottom, but really, I mean, it makes sense from a structural standpoint, and this could actually be a good play to play it back up and kind of see what happens to trade. So we'll talk about that if it were to occur on this brief, so make sure you obviously subscribe to the channel. Let's look at the expected moves and the statistics. Now, going into next week, it's a shortened trading week. So we got Labor Day weekend, $8.66. That's actually more than this last week, and it's not too far off the week prior. And just I want to remind you once again, that's pretty impressive because it is a shortened trading week. So we got a lot of volatility packed in going into next week. On the SPY, you have the month-to-date level at 621.83, 668 above us, and we have yet to reach our quarter-to-date, but we're not too far off, and that's at 664. Now, you might be wondering, okay, well, what are the statistics behind this? And I usually talk about that as far as a distribution curve, right? 68% of the time, we typically go and tag it and or close within it. And then we have our two standard deviation levels, right, at 95%. It'll close within a 95% of the time. Now, when it comes to the S&P 500, the big products like the SPX, right, the bigger products, you typically get a higher percentage. So the statistics from a year-to-date basis, there have been 35 trading weeks. This is important to know just to give you more insight as to why I track these and why they're so important. Now, this is just this year-to-date. I do have statistics going back, 5+ years. But right now, we've had 35 trading weeks, okay? Now, we have tagged that EM 26 of the 35. That is a 74% probability, right? So that's higher, right? 68% of the time, we say we tag it and close within it, right? 68% of the time. We actually tagged it 74% of the time this year, which is about 3 out of every 4 weeks. Now, we closed outside of it 15 of those 35 weeks, which is 43% of the time. And that's actually kind of high. So the market's been actually somewhat managing the risk expectations poorly this year. However, when I looked into it a little bit deeper, 6 of those weeks out of the 15, so basically half of them, a little bit less than half, they've barely closed outside of the EM. So I'm counting it as a close, but we're talking like if the EM was right here, maybe we closed outside of it right over here. So it was very minimal. A lot of people would probably look at that and be like, nah, that's a tag. That's just closing at it. But I did want to kind of give you that, both the statistics and an actual close outside from the pools of the data that I do. Okay. Now, only 20% of the time, right? 20% of the time, 7 of those weeks, there was no tag. And basically 4 of those times, they came within 2-week streaks, right? So we'd have 1 week no tag and then another week no tag. That happened 2 times. And right, so only 7 weeks out of the 35, we've had 0 tags of the week. So basically, if you know where the expected move lies, there's a high probability that we go and tag it. And that could come from a daily perspective or a weekly. I'm doing this from a weekly perspective right now. That's the year-to-date statistics from a weekly perspective. Last week, we did not tag it. So I counted that as a no tag. You can see over here, though, the daily, guess what? We came right into it and we just doodled around, right? No real substantial break. We just doodled around it. Now, next week, we're looking at 654.91 to the upside, or 653, right? I have a zone because I use my Asherbot, which is part of the Discord. It's a proprietary just calculation utilizing some data here that generates these levels, and it creates more of a zone. And then this weekly implied move that I also share is derived directly from the options chain. And you can see over here, 630, 639. So this is what the week's pricing in as far as risk. And 74% of the time so far year to date, we go and tag it. So I'd be looking for a tag in either direction. The lower daily implied move is right here at 641.19 and change, 647 right above us. And we're currently below that 5-day moving average as it stands right now. Another interesting kind of tidbit is I did want to call out the IWM actually tagged its quarterly expected move, and we closed outside of the month. So I'm not going to give the updated ones on these ones now, but we did already tag the quarter expectations for IWM. Now let's go ahead and hop into Bitcoin. I'm going to start off with the sailor to shift tool. We did have an official sell trigger on this last week here. And you can see we've sold off into and around 108. So the sell trigger is on. We went over it on either last video or the next. And this is measuring the rate of change, the 4-week rate of change between Bitcoin and gold. So clearly Bitcoin dropping. Gold is breaking out near these highs. Maybe perhaps we go to 3,500. A lot of people are calling this triangle breakout. But in all honesty, we're kind of just in this range, a little bit bigger of a range, right, over here. So perhaps maybe we do head higher, maybe we consolidate more, but, we'll see what happens here, especially in a month in September where the dollar, most of the time from a seasonal standpoint, rises. And if that is the case, well, gold typically has a negative correlation. Look how it's running up over here. And what has the dollar been doing the last 4 or 5 trading days? Kind of been going down. So the negative correlation is there. And if the dollar moves higher, it could just put a little pause on the price of gold after this breakout, but we will see what that looks like. Now, I do want to call out the Bitcoin as a potential leading indicator. This chart came from the market here. I didn't want to create it all myself, and so I just took their chart. They don't care. I shared this on a prior video too. But you can see here, Bitcoin has been dropping, and it's had a tight correlation to the S&P 500. And you can see the S&P 500 barely moved, right? And not only that, but you also have the NASDAQ, right? They've been trading very, very tight correlations, but you can see the correlations breaking, right? Bitcoin came off and the NASDAQ hasn't followed. So is Bitcoin acting as a risk-on leading indicator to these markets? Now, I don't have that answer for you, but so far it has been quite astonishing, right? You had Bitcoin fall over here shortly thereafter. The NASDAQ followed. Another interesting chart is just Bitcoin and NVIDIA. And you can see very tight correlation, and yet Bitcoin's been falling and NVIDIA's kind of been going sideways. And if you look at something like the semiconductors ETF, SMH, right, a lot of people are calling out its little head and shoulders over here, an advanced head and shoulders pattern, potentially. Right? And if that's the case, and if this breaks, we can see a move down to and around this 260, maybe a little bit higher. You do have the RSI and the MACD both showing divergence in its move as the markets press higher. But overall, we're just kind of going sideways. And then if you look at relative strength too, it's kind of just boxed out in this channel. So a breakdown of relative strength would also imply some weakness there too as well for the semiconductors, as they've been obviously just on a monster run from 170 to 300. this year. So it's been quite crazy. Interestingly enough, since we're talking about NVIDIA, I thought this was pretty cool how NVIDIA is underperforming from a year-to-date basis Alibaba. And when I looked into this a little bit deeper, I found some cool charts here, and that was flows into China. So if I'm looking at China, you can see this red line, the net longs, right? Flow is getting quite increasingly big versus the shorts have been falling. And then if you come over here to more cumulative gross flow, a massive run higher in the flows into Chinese equities. And if you look more in the Asia markets, you can see China, Hong Kong, right? Those have been kind of outliers here. And you saw a big move here recently too in the month of August. So keep your eye on some of these China equities. Clearly, BABA had earnings, and that really prodded up about 12 to 13%. So you'd want to pay attention to these, because if we keep continuing consolidations and strength, that could be where we see some rotational things, rotational money, institutional money potentially go into and chase it higher. That's all I got for you on today's video. Hope it helps out, and I'll see you back here on the next.